Hi, you're watching Investor Insights, and in this video I'd like to talk about the consequences that will arise when the Fed decides to hike rates. Now, just a little background to this video. As you probably know, the Fed is price fixing rates at the moment in order to stimulate the economy. The US government has a lot of debt, and it's acquiring more debt, first of all to pay off its old debt, and secondly by keeping rates low it provides a lot of cheap monies for the economy to use up and free up and spend and consume and increase GDP. The Fed is fixing both the bond market, as in the treasury rates, and mortgage rates through the purchases of mortgage-backed assets. And the Fed spends about $85 billion a month, 40 of that being in direct treasury purchases and $45 billion in mortgage-backed asset purchases. Now, as all these assets, $85 billion every month, adds up to over $1 trillion every year. They have to print a lot of money to fund those purchases. Now, if you've been watching previous videos, you're going to learn, or you probably have learned, that money printing leads to inflation. And the amount of inflation is directly proportional to the amount of extra money printed relative to the same number of goods and services that it can buy. Now, anyway, the Fed can try and keep rates low for as long as it wants, but it's the market that's going to force the Fed to hike rates. And the market force that's going to do that is inflation. It's going to be hyperinflation, just rampant inflation. Inflation that they haven't seen since the Great Depression. Well, what's the consequences of the Fed hiking rates? Well, the first will be that basically America defaults on all its debt. It does so because it can't afford the interest. And right now, the US spends about $250 billion, $250 billion, on interest payments a year on its $17 trillion worth of debt. And that's cheap. That's basically nothing. You and I can't get a mortgage or a loan at that rate because it just doesn't happen. And how people are lending the US money at that rate, I wouldn't know. So if the Fed hikes rates, keep in mind that rates now are almost at zero. Technically they're at zero, but because they can't have zero, they just say it's between 0 and 25 basis points. But we all know it's within 1/1,000,000th of a decimal point to zero. So if you've got all these debt and you're paying no interest on it, what happens when you hike rates? America can't even afford to have higher rates than 0. So if rates go to, for argument's sake, 5%, you take a look at 5% of 17 trillion, that's 850 billion. They have structural budget deficits of $1 trillion. They're going to have to double the budget deficit just to pay off the interest. That's not going to happen. So technically they have to default. And although it's going to seem to be a nightmare, well, the whole global financial system will basically implode. And regardless of how unbelievable it sounds, that's what's going to happen. Secondly, the mortgage market in the States would implode, disappear, crash, never to be seen again. Because right now there's a housing recovery happening, but it still hasn't, it's not really of any note whatsoever. And just because it's a dead cat bounce, and that's all that it is, after all these artificial rates have been put into the system, what's going to happen when rates actually have to go high, much higher? The same thing will happen in the global financial crisis. People will just default on their loans, walk away, and there's just going to be a whole bunch of losses, both to the Fed in terms of all these mortgage-backed assets and to the banks who hold all these assets. And of course the suckers who the investors or speculators that bought into these mortgage-backed assets. Thirdly, every bank in the States will fail. They will implode because banks make their money from low rates in the States. That's all that they do. They just take cheap money from the government and just channel it through leverage into more speculation, and the speculation is very low yielding anyway. And when rates go up, there's no more cheap money to fund their speculation. They're going to have huge losses on their books, and the banking system this time will fail for real. The last time the banks were bailed out by the Fed, it can't happen this time because the Fed won't have any money to bail them out with. Because as the Fed is tightening or hiking rates, it just doesn't have any funds available to it to do anything with, whether it be bailing out or whatever. So the banks have never taken this scenario into their recent stress tests. The Fed made the banks undertake a whole course of stress tests just after the GFC and subsequently every year afterwards or thereabouts. And in every stress test, they look at higher unemployment, maybe 10% unemployment, which already has happened. The stress test will look at things like asset losses. They look at, which already has happened, by the way. They look at higher inflation. They look at all sorts of weird and funny factors which have already happened. So therefore, if the banks didn't fail then, they're not going to fail now. But apparently, the Fed has never put rising rates as part of the stress tests because they know that if the banks had rising rates as a condition of their stress test, one of the components of the stress test, that would all fail to oblivion and never come back. And in real life, that's what's going to happen. And unfortunately, this time, it's not just the shareholders of the bank or the bondholders. The depositors will be taken out as well. So all these poor mum and dads who put money in the bank, thinking that the FDIC has their deposits insured, well, the Fed has no money to fund the FDIC's insurance on everybody's deposits. It has no money. The government has no money. So therefore, when the banks become undercapitalized and the losses mount and they go under, the depositors go up, they will just disappear with them. This is huge. This has never happened before. This has actually happened before in other countries, but not in the largest economy on the planet. So you've got three huge consequences to the Fed raising rates. rates are at zero. Even a little raise is going to start these three things happening. And when inflation starts to run, they have no choice but to hike rates, and hike rates quick, and hike rates big. Imagine the size of that implosion. Imagine you fully invested in any asset class that was blown up, inflated by all this Fed action, which technically is every single asset class. Take your money, flush it down the toilet, you're going to know exactly how that's going to feel like when this thing happens.